Home equity loans are a fantastic tool if you do not want to break your current mortgage in order to consolidate your debt. Home equity loans are a fantastic tool to use if you have a favorable mortgage that have great terms associated with it. If you have a mortgage with a 2% rate and you don't want to disturb that or be hit with additional penalties associated with a refinance, but you still want to pull the equity out, looking at a home equity loan might be a great option. Think of it like a sidekick to your primary mortgage. With a home equity loan, you're able to access, like a refinance, up to 80% of your home loan to value. So again, if you have a $700,000 home and you have a $450,000 principal remaining on your mortgage, you can draw up to $110,000 of equity. So home equity loans have a great upswing, especially if we're looking to consolidate our debt and not wanting to break our mortgage. But they do have downfalls. Because the home equity loan falls in second place of your primary mortgage, many lenders might not lend to a current borrower, or they're going to tack on a higher interest rate. Because if that borrower falls into default, that primary mortgage and the lender associated to that first mortgage is going to be paid out first. The lender that's going to be associated with that second mortgage or that home equity loan is going to be paid out second. So let's take a look at an example of what consolidating our debt on a home equity loan would look like. We're carrying $50,000 of high interest debt, $20,000 of credit card at 20% interest. Our minimum monthly payment is $350. $20,000 of a personal loan at 10%. We're paying $500 a month. And a $10,000 used car loan at 10% that we're paying $500 a month for. Our current expenses for just this debt alone is $1,350. Let's take a look at our property and our mortgage. Our property value is $700,000. Our current mortgage principal is at $450,000. We're sitting at a 2% interest rate spread over a 25-year amortization. Our current monthly payment is $1,905. If we took a home equity loan of $50,000 to cover our debt at 7% interest with a 5-year amortization, our home equity loan is going to be $987.80. If we took a look at our cash flow, our primary mortgage and our debts are going to be $1,350 plus $1,905.53. This equals $3,255.53. Now, if we look at our primary mortgage and our home equity loan, which I'm going to call our second mortgage, our total expenses for that is going to be $2,893.23. This gives us a cash flow $362.30. Like I said before, anytime we're trying to consolidate our debt and anytime we come up with positive cash flow, we're going to try and put that additional cash flow against your debt, or in this case, your mortgage or your home equity loan, to get that debt paid off sooner.